So in this video, I've selected some of the topics in the PowerPoint. You're welcome, of course, to review all of the PowerPoint slides that I have posted in Blackboard. But I've selected a few of these to go through some of the more salient and I think more important topics in the chapter. The emphasis of what we'll be discussing will revolve around Form 1040A. And 1040A is the primary form that we'll be, as I said, focusing on in this week, this chapter. And we'll move ahead into 1040 and cover 1040 and various aspects of the form in the remaining weeks ahead. But for this week, we're going to take a look at the 1040A. This happens to be a tax form for Jose and Dora Hernandez. And I'll be kind of jumping back and forth between PowerPoint topics and then this form where we find the line item on the form which relates to the topic that we're discussing in the PowerPoint. All right, so first of all, the 1040A, as mentioned in the text and in class last night, is a slightly more complex, comprehensive tax form, permits additional information to be recorded on the tax form. Not as complex as the Form 1040, but it does provide an opportunity for more taxpayers to report their taxes. So here's the general expanded tax formula. And of course, gross income includes all the items that you would have learned about in Chapter 1. And throughout this course, we'll talk more about the gross income items, as we do problems and exercises and connect and in the text. So we have gross income, and then we deduct from that the permitted deductions from gross income. These are page 1 or on Form 1040A deductions that will influence that all-important adjusted gross income number. And the AGI number is unique to Form 1040 and individual taxpayers. So we'd like, if we can, to deduct as much as we can from page 1 to get that AGI number as low as possible. And the reason that that's important is because we would like to qualify for more deductions on page 2 in Schedule A, and many of them are based on a percentage of AGI. So we would qualify for more deductions if we have a lower AGI number. Then on page 2, we'll take either the standard deduction or itemized deductions. And then we have personal dependency exemptions, and that's $40,050 this year for each exemption. Then we wind up with the taxable income multiplied by the appropriate tax rates, and that is what our calculated liability is. And when you determine your tax liability, you can either use the tax tables, as we learned in Chapter 1, or the tax schedule. And the tax tables are available for those who have $100,000 of income or less. Otherwise, we have to defer to the tax schedules to calculate our tax obligation based on our taxable income, our TI. Once we determine the tax liability, we can take off tax credits. And you might recall that tax credits are a dollar for dollar reduction in our tax liabilities. Some tax credits, as we'll learn in Chapter 9, can create refunds, and they're refundable tax credits. Others are not, but will be available to reduce our tax obligation to 0 if that's possible. And then we'll add on other miscellaneous taxes, which we'll talk about in the weeks ahead. And then finally, we have we're going to deduct from that our tax payments and refundable credits. And tax payments for most folks are the amount withheld from their income by their employer. Also, I mentioned refundable credits before. Some credits, such as the earned income credit, is refundable and can create a refund. Finally, then we wind up with our tax refund or our tax due with refund. That is to say, we owe more because our liability exceeds what we paid in. So in Chapter 2, we focus on filing statuses and the tests that we need to take in order to determine whether or not, for example, we can claim another person as a dependent and therefore be entitled to their exemption. So there are 5 filing statuses: single, married, filing joint. And we'll talk a little bit about what married filing joint means as we move ahead. Married filing separately, rarely, but occasionally, it might be advantageous for married taxpayers to file separately. Again, this is the exception, but if, for example, their combined income is high enough where it may exclude them from taking advantage of certain deductions or contributing to a Roth or traditional IRA, or the exemption phase out for personal exemptions. So there may be a variety of reasons where the combined income level gets so high that it excludes the married couple from some of these available deductions and credits. If the married couple do decide to file separately, then the standard deduction must be taken for both parties. In other words, one party filing separately, one of those spouses cannot file separately, cannot file an itemized return while the other one uses the standard deduction. And yes, the Social Security number of the counter party, in this case, the other spouse, would have to be disclosed on the taxpayer's tax return. So each spouse would have to report the other's taxpayer's ID number, which in this case is their Social Security number. Another filing status is the head of household. Here, generally an unmarried taxpayer who has a child and provides more than half the support for that child, or qualified relative, then would file as a head of household and get, for example, a higher standard deduction than they would if they were filing as a single person. Another filing status is qualifying widow or widower with a dependent child. And as I mentioned in class last night, the child does not have to be the biological child of the taxpayer. This can be an adopted child as well. And a qualifying widow or widower is an opportunity for the surviving spouse in the years after the year of death to be treated as though they were still married and can file jointly. In other words, they can file married joint, and we call that filing status a survivor's filing status, or a widow or widower. So they get the benefits of filing as though they were married filing joint, but since they're not married, we call it or refer to it as the married surviving spouse or qualifying widow or widower. That opportunity to file with this preferred status is available in the years I mentioned, in the year after the death, and then the year beyond, the second year after the death. Generally, though, this opportunity is lost if the surviving spouse remarries. And as I said, there must be, for the second and third year of qualifying status to be the qualifying widow or widower, which again is the first and second year after death, must maintain the household for a child and provide more than half their support. By the way, just to go back for a minute, the year of the death, even if, for example, the deceased spouse died on January 1, when the surviving spouse files a tax return in the following year, that surviving spouse would file a married filing joint. So they do get the benefit in the year of death of married filing joint, whether they have a dependent child or not. But in the following 2 years, as I mentioned before, then there must be, it doesn't have to be a biological child, could be an adopted child, and provide for more than half the cost of the household. Personal exemptions, I mentioned earlier, these are generally available to the taxpayer's spouse, and dependents that are claimed by the taxpayer. The amount is $4,050 per exemption per either spouse or per dependent. As I mentioned a little bit earlier, there is a phase out for personal exemption. And so when incomes get too high, that opportunity to claim that $4,050 begins to phase out. So who is a dependent? They must be a qualifying child or a qualifying relative. And there are tests then that are to be taken to determine whether or not a dependent is a qualifying child or a qualifying relative. Either of these two can be claimed then as a dependent, and therefore the taxpayer would generally be entitled to take the exemption, the $4,050, for those dependent or qualifying childs or qualifying relatives. Generally, the person cannot file a joint return with his or her spouse unless the return is filed only to claim a refund. So if you're married to somebody else, it's unlikely, but as I said, there's a possibility in this case, if you're only filing to claim a return, to claim that person as a dependent. Otherwise, married people generally would file their own returns, not be dependents of anybody else but themselves, and would be entitled, the taxpayers and the spouse would be entitled to claim their own exemption. Also, if someone else can claim the taxpayer as a dependent, then that exemption then is available to the taxpayer who is entitled to claim that person as a dependent. The dependent, even if they file their own tax return, cannot claim the $4,050 exemption because they're not entitled to. For example, their parents may be claiming them as a dependent. So, for example, a teenage daughter may be working part-time, files a return to obtain a refund, but that child, while they may be entitled to take a part of the standard deduction, or all of it, depends on how much the child earned, may not take, however, the $4,050 exemption because their parents are claiming that child as a deduction on their tax return. So what is a qualifying child? These are the tests then, the relationship test, age, residency, support, and special test for a qualifying child of more than one taxpayer. Here, that last one is interesting. If a child is being supported by several people, those who are providing support greater than 10% may be able to claim the dependency exemption. But there must be agreement, there must be disclosure of all of the parties who are providing support for a child. I suggest you review in the text these tests in detail. Just the age test generally is under 19 if the child is not attending college or higher education or school, and under 24 if they are attending school, college or school.